Afternoon. Good afternoon, everyone. Thank you so much for joining us today as we are joined by the team at Standard Investment Bank, the global markets team, and we are going to be discussing about the markets and how it performed in the last quarter and what we are looking forward to in the next 3 quarters that are remaining of the year. Of course, because we have an election year, we have geopolitical and a lot of things that are happening in the world right now. So we need to review how it performed, what we need to look out for. I mean, we got from COVID to another, when we were just getting settled up and living with COVID, another Russia and Ukraine happened. So of course it threw a lot of things out of balance, and it's a ripple effect and we can feel it everywhere. So we need to understand what we are supposed to be investing in right now, and also understand that we need to also be going with our own risk appetite when it comes to the investments. So yes, karibuni sana. My name is Rose Ella from Vasili Africa. What we do as Vasili is basically financial education, financial literacy to everyone and everybody. And that's why we have these webinars very many times, so that we can be able to understand what is happening in our world, so that we can be able to take control of our money. I always say money is our servant. It shouldn't be our master. Yeah, so we should learn how to control it. So if you can hear us, asanteni sana for joining us. Nahashon, tell us if you are okay.
Yes, Ella, thank you.
All right, great. So tell us, how was the performance of Mansa X? I don't need to introduce you. People know you by now.
Okay.
Yes.
Okay, so the first quarter of the year, we returned 3.8%. That's an annualized return of about 15.25%.
That's good. That is good, and that's a net return.
That's a net return, yes. We always quote our returns net fees.
Okay.
Yes.
So in simple
I think we lost you there, Ella. So as we wait for Ella to get back, I'll just quickly
sorry about that. Just a small technical glitch. We're resolving that and then we'll resume shortly. Please bear with us.
Okay, good afternoon, everyone. Sorry about that hitch. So I'll be using, I'll use this this computer instead. So we're going to keep today's presentation very short. I'll mostly just take you through the Mansa X Q1 performance review and give you a brief outlook of what to expect.
So as we wait, we're having a small technical issue and we are sorry about that. Would ask for your patience, then we can continue. But in the meantime, please shoot all the questions that you may have in the chat. We shall address them at the end of the session. We shall be having a very small presentation, about 10 to 15 minutes. And then after that, we shall be having the Q&A session. So hopefully by around 4:15, we should be done. So we ask for your patience right now as we wait for the technical issue to be sorted. However, you can also tell us what your expectations are from the webinar and what you have experienced in the market so far. Thank you so much. But keep the questions coming, and we are live streaming on YouTube. So we shall be sharing a link for those who might miss this recording, who might miss this webinar. We shall be having the recording on YouTube. Thank you. Thank you so much for your patience, everybody. Let me see whether I can see people I know here. Okay.
Hi, everyone. Sorry about that.
All right.
I'm back.
All right. That's great. So yes, we already have a poster, but you can continue first with the presentation.
Oh, okay. Okay. So like I was saying, we're going to make this presentation very short today because we noticed from our last webinar that there were a lot of questions from the audience. So we want to focus more on getting to answer your questions and to receive any feedback from both our investors and other stakeholders who are in this performance outlook webinar. So I'll make it as short as possible. So my name is Nahashan Mungai. I'm the Executive Director for Global Markets here at Standard Investment Bank. I'm also the portfolio manager for the Mansa X fund.
Great. Thank you, Nahashan. Florence, I see you. We shall explain what Mansa X is all about. George, I see your question. Hilda, I see your question. Yes. Great. Thank you, Hilda, for that question. We shall cover it as we go along. Actually, I think you'll be able to understand it as Nahashan presents. Agnes, thank you for being here. Simon, yes. That's feedback that we can take. Thank you so much. Nahashan, everything okay on your end?
Yes, Ella, everything is okay. Just sorting out something on this slide.
All right. But something to note is you performed exceptionally well in terms of against inflation, that is, if I would look at the annualized returns, that is 15% versus the 5%, inflation rate that we have, which is the kind of investments, the kind of investment solutions that probably we should be having in our portfolio. Anything that is yielding much more than the inflation is good right now because things are getting harder. Yes. So we need to have a yield that is way, way higher than the inflation. I think you're okay now, Nahashan?
Yes, thank you. And thanks for the compliment about our return. All right, so I'll get right to it. So what is Mansa X? Just a quick definition of what the fund is. It's a multi-asset strategy fund. This means that what multi-asset means is that we trade in various asset classes to give the return that we deliver to our investors. And we use a long-short trading model, and I'll explain that later, allowing us to give returns to our clients while protecting the downside. And just to reiterate, we are licensed and regulated by the Capital Markets Authority as a money manager in this regard. Our minimum investment is 250,000 shillings with a minimum top-up of 100,000. We have a lock-in period of 6 months with a financial services charge of 5% per annum. But we prorate this over the 365 days that you invest with us. So we don't charge you upfront, and you're really only charged for the period that you have invested with us. We also charge a performance fee if we deliver a return for you that exceeds 25% per annum. Our main custodians are I&M Bank, and we're also very happy to say that we have one of the quickest withdrawal periods. We can withdraw your funds at least a minimum of 2 to 3 days. We are currently managing about 8 billion shillings right now on behalf of our investors. So what are the asset classes that Mansa X invests in? So our main focus is mostly markets that are domiciled in the global financial space. So we invest in stock indices of various markets, like the New York Stock Exchange, the London Stock Exchange, and various European markets. We invest in single stocks from around the world. A lot of our stocks are mostly in the American market, but we also have continental Europe as well, and British stocks as well. We also trade commodities. So here we're talking about oil, natural gas, wheat, sugar, and so on. We also trade precious metals, for example, gold and silver. We also trade currencies, most currencies from around the world, most of the G10 currencies. So you're talking about the euro, the dollar, the yen, Swiss franc, Australian dollar, and so on. We also trade in derivatives, and derivatives, basic definition of derivatives are really just asset classes whose value is derived from an underlying instrument. So in this regard, we trade asset classes like forwards, we trade options, we trade interest rate swaps, and so on. And if anyone wants more explanation about this, I can always give you more information in our Q&A session. The fund is also very heavily, we hold a lot of cash as well. This helps us to be one of the most liquid funds around, especially a fund that gives the sort of returns that we give. Typically, if you have a high liquid fund, then your returns are compromised, but that's not the case for Mansa X. We have managed to solve that issue. We also trade in fixed income. Fixed income means trading in government bonds and from various markets around the world, as well as locally as well. We also trade in our own local stock market. So just because we are mostly biased towards international markets doesn't mean that we don't trade our own markets. We do. In fact, if you look at our top 10 holdings, you'll see that one of the stocks we own there is actually Safaricom. We also trade in exchange traded funds. These are really passive investments where you bundle together stocks that have similar attributes and then sell them as one unit. Those are called exchange traded funds. So one of the biggest benefits of this fund is that you get real diversification. So when we started Mansa X about 3 years ago, one of the key things that we were trying to solve for the Kenyan market was to give our investors genuine diversification. Diversifying your portfolio does not only mean buying different asset classes. You also have to buy asset classes that are not correlated. So sometimes if you are only invested in one market, for example, the stock market locally only, and something happens to the Kenyan market, then even if you had bought different stocks in that market, your portfolio would still take a hit. Now in Mansa X, because we are able to buy different asset classes, we give you real diversification. So because you have exposure in stocks on one side and then exposure in commodities, for example, exposure to metals, exposure to derivatives, This means that if one asset class is underperforming, then the other one can hold up your portfolio. And this is one of the biggest advantages of investing in this fund. And of course, you're exposed to various markets, which because they are global and from Sydney to New York, this allows you to have exposure to real-time markets around the clock, 24 hours a day, 5 days in a week. Another advantage, and this is a significant one, especially when you see how the shilling has been performing lately, because a lot of our investments are made in foreign currency, we are able to give you returns that adjust for the shilling depreciation. And this, again, is one of the biggest advantages for our clients. And leverage is also one of the tools that we have within this fund that is also very unique to Mansa X. This means that we can actually trade amounts that are bigger than what our investors have put up with us. Leverage simply means using borrowed money to take positions in markets. Of course, it's a double-edged sword, but it helps to increase returns more than you'd have typically made if you could only invest with what funds that you have. Trading opportunities. This is one of the other unique aspects of this fund. And this is why I explained the long-short trading model. So going long markets means that you make money when the underlying asset that you have invested in gains in value. Whereas going short means that you actually make money when that asset class that you have gained exposure to is losing value. Now, this is very unique and helps us to take advantages of whether markets are rising or whether markets are falling. So a lot of our investors were concerned when they saw what was happening in Russia invading Ukraine, and they were concerned that markets were losing value. And we got a lot of phone calls from our investors asking us whether their funds are safe. And I want to emphasize that, in fact, some of those opportunities actually are created by that conflict. And that's because you can go short certain markets and make money when those stocks are losing value. And I'll explain that later and give you a few examples. Liquidity, I'd mentioned this earlier, the fact that you can easily access your funds. This is another value proposition of this fund. And this is a big deal because, and I've said this before in other webinars, we as Kenyans sometimes can get very fixated on returns and forget that sometimes the ability to access your money as and when you need it is just as important as having a good return. So our fund has been designed in such a way that at any one time we have very good liquidity. We are very cash rich, meaning that whenever investors want to access their funds, they can access their funds within a very reasonable period. In fact, most of the times if there's a delay, it's really something to do with banks, whether ours or the client's banks, but not really because we did not send the funds on time. Then of course, the fact that we are locally present. This fund and the way it operates is very much the way global hedge funds will operate. And we do something that's not very unique in most Western markets, but it's very unique in African markets. But the advantage you have is you could still invest in those funds, but you don't even know where their offices are. If you had an issue, you don't know how to reach them. The advantage you have with us is that you're investing in a fund that's giving you a global exposure while still giving you local presence. And that's another advantage that you have investing in Mansa X. So I'd mentioned earlier that our annual return to date, at least for the first quarter, is 15.2% after our fees. And as Ella said, this return is above average. Most funds have not done a return close to this. And that's because of the diversification and exposure to various asset classes that we have. A lot of people will ask, does that mean that if you're getting a higher return than most funds, are you then necessarily more risky than the other funds? The two are not correlated. Sometimes you can have a higher return purely because you have more asset classes that you are investing in. And that's exactly why Mansa X makes a higher return, not because we take disproportionate risks. In fact, you can have a fund that's giving you a less return and assume that it's a safer investment, but it's really exposed to very few asset classes. And if anything happened to them, then your return would still be wiped out. So return, you can have a high return without necessarily increasing the risk. And that's the case with Mansa X. So that's how the chart looks. Our average return since we started the fund is around 17% after fees. And for anyone who invested with us, say, in 2019 and has stayed with us for the last 3 years, if you had invested a million shillings with us in 2019, by now your funds will be up to 1.73. And I'm sure a lot of you will agree that that's a decent return. And Ella mentioned something about, we should not be slaves to money, and money should be working for you. This is an exact definition of money working for you. You're putting a million shillings, 3 years later, it's at 1.7 million shillings, and you did not have to do any heavy lifting. You just had to invest money with Mansa X. So our top 10 holdings, we get this question a lot of times, so we started including this in our webinars. People asking us, what are your top 10 holdings? Now, I want to clarify that our top 10 holdings will vary from time to time. What you're seeing for this quarter is very different from what you had in the last quarter of 2021. And there are reasons for that, and I'll explain later. But for this year, our biggest holdings were in bonds because of the cash aspect of the fund. We are significant traders of FX derivatives. So these are Forex derivative contracts, like the ones I mentioned, forwards and options. We hold Safaricom. It's been one of our top 10 holdings for quite a while now, from about 2 years ago. We had a significant exposure to ExxonMobil. That's an obvious one. This is because we're trying to take advantage of the geopolitical tensions that have pushed up the price of commodities, oil being one of the ones that rose the most. We saw crude oil prices jump. WTI jumped from $89 a barrel at some point to $130 a barrel. Of course, it's retraced a bit now, at around $100 a barrel, but we still think that there'll be upward pressure on the prices of commodities. For us to benefit from this and to make sure our investors are earning from these pressures, that's why we own companies like ExxonMobil. And as a Kenyan, if you're stressed about the prices of fuel going up, you should be very happy that you're invested in Mansa X, because you still make money because we're invested in oil prices going up. We were also invested in General Dynamics. That's a defense company. For obvious reasons, a lot of governments around the world are now increasing their defense spending, especially in continental Europe. Of course, this is driving up the share prices of companies that are in the military business. Adidas was one of the stocks that we shorted. In fact, this one we don't hold to the hope that the price will rise. This one we hold with the hope that prices will drop. Why is that? Inflationary pressures, the first thing that happens when inflationary pressures increase is that consumer spending reduces, and this causes stocks, especially for non-essential goods, to lose value. So Adidas, obviously, a lot of their products are non-essential. You're talking about sporting goods, and that therefore was a reason for us to go short that stock. Lockheed Martin, this is a stock that we own. We are long this one, hoping the prices will go up, and they have. We saw that the prices go up in the first quarter of this year. In fact, Lockheed Martin gained about 25% in the first quarter of this year, and we have been long that stock. Again, this is a defense company. So as governments in continental Europe continue to increase their defense spending, we still think that there's a lot of value to be earned by holding that stock. We are big buyers of oil contracts. In fact, that's one of the. In fact, I think if we did this slide if we had to adjust this for how the current situation is, oil is one of our biggest contracts right now, along with gold. We believe that commodity prices will continue to increase. Gold prices, we believe also will continue to gain in value as a flight to safety. So when markets are uncertain about the future, when people are uncertain about the future, a lot of them will buy gold, and that's why gold prices have continued to see upward pressure on their prices. And cash. The fund tends to hold a lot of cash, and this is one of the reasons why investors should never be concerned about the liquidity of the fund, because we're always liquid enough to pay out. So our selective plays for Q1 2022, the ones that we liked the most, I'll start with the short positions, where I mentioned that we make money when the stocks actually lose value. And that's why I said that Mansa X is a multi-asset strategy fund with a long-short model. So it means that we can go long and we can go short. The short positions we are holding, or rather that we were holding in Q1, and some of them we still hold, although I see some we have exited. First one is Adidas, and I explained that. Then there are technology stocks. A lot of technology stocks had seen a lot of overvaluation in the last few years, especially because of how the Federal Reserve had pumped a lot of liquidity into markets, essentially just printing money. So what this had done is that it had created very high valuation numbers for a lot of technology stocks. Now, with what is happening right now, fears around inflation numbers and concerns about geopolitical tensions in continental Europe, then you see a lot of investors starting to question the valuation of most of these stocks. You had stocks like Roku, PayPal, DocuSign, Netflix. You saw them losing value, and we expect that they'll still be under a lot of pressure to lose value. We're even now looking at stocks like Square, currently called Block, again to go short because of the same reasons. So moving into Q2, we'll continue to monitor this very closely, and with the expectation that there will be more loss of value for technology stocks. Long positions, it was mostly for commodities. Our biggest plays in Q2 were actually commodity plays. We made significant returns by going long oil. We made significant returns from wheat, corn, soya bean. We went long gold as well. I think we forgot to mention here that we also had positions in sugar as well, and coffee. Those were also long positions that we are holding in Q1, and we expect that in Q2 there'll still be upward pressure on their prices. So what's our outlook for Q2? Of course, locally, the biggest issue is elections. A lot of investors are wondering, should we have money invested with you for elections? There's always this fear of how are we going to survive elections and the kind of tensions that come from it. Now, this is exactly one of the reasons why you invested in Mansa X. And this again proves and continues to validate our concept that we give you the ability to be exposed to various countries. So if you have elections in Kenya, you're not concerned because we're still making money by trading in the New York Stock Exchange. If anything is happening in the US, you're not concerned because we can still give you exposure to Asian markets and so on. So my off the top of my head, I'd just say to our investors, don't worry about the general elections. Mansa X will continue to trade normally. And a lot of our exposure, we don't have a lot of exposure to the local market anyway. The NSE, we expect that there might be downward pressure on the prices of most stocks on the NSE, not necessarily because companies are not performing well, but because a lot of our investors in the stock market locally are actually foreign investors. About 70% of the stock market is usually foreign investors. And when there concerns, when there's risk aversion globally, like it's happening right now because of geopolitical tensions and because of concerns about central banks raising rates and so on, then you see a lot of them pulling out of what are considered risky markets. So Kenya is one of the ones that are considered risky markets because we are a frontier market. So because of that portfolio realignment, then you see stocks dropping locally. So that's still expected to continue. It's not mostly to do with elections, but really just because of what's happening globally. Outlook from a global perspective, the Ukraine conflict. Of course, right now, some of the things that are happening in the world right now, if you talked about them last year, it would have sounded very strange, but they're happening now, complete with Russia invading Ukraine. And just as recent as yesterday, Russia even talking about a nuclear attack. So this sort of thing will continue to affect markets. The first thing we expect will happen is that commodity prices will continue going up. We are very long commodities, soft commodities, especially because we believe there'll be a shortage of supply of commodities like corn and soybeans and wheat. So we have taken significant positions in those, expecting that the prices will continue to rise. We expect that the conflict between Russia and Ukraine will last much longer than they had expected. Russia and Ukraine are major producers of wheat. In fact, that's where we import our wheat from as a country. So we expect that this will continue to push up these prices, but worry not if you're a Mansa X investor, because you're taking advantage of that. Central bank actions. Right now, in the US, we are at the highest inflation levels we have ever seen for the last 40 years, since 1982. Because right now the inflation rate in the US is 8.5%, and that's the highest we've seen it in 40 years. So we expect that central banks around the world will continue increasing interest rates. And this has an effect of also pushing down stock markets, especially if they have overvalued stocks like this technology stocks I talked about earlier. And we'll expect to see that continuing to happen. We had expected that the Federal Reserve will increase interest rates in the Q1, which they did in March. They increased by 25 basis points. There are talks about them increasing rates and also increasing rates at a faster pace in the next few quarters. So we'll be watching that very closely, and what it does to bond yields as well. Supply chain constraints will continue. One of the reasons why we had supply chain constraints last year was because of this zero COVID tolerance policy of China. So if one person is infected with COVID in a certain port, then they'll close down the port. And this sort of thing created a lot of delays at ports. And this sort of, again, spilled over into 2022. Now, again, you have what is happening in Russia, again, exacerbating an already bad situation. Supply chain constraints will lead to even more inflation as goods start being priced higher because of lack of delivery and lack of being delivered on time. And this, again, we expect to continue to push yields higher. Higher bond yields. I put out a video last week, and one of the things we mentioned was how we were surprised, but how yields have really risen. Right now, the US 10-year treasuries are at around 2.8, and that is a 400% increase from where they were at the beginning of the year. Where do we expect them to go? We actually expect US treasuries, the 10-year yields, to go above 3%. Now, why is this important? So if you look at the average dividend yield of the New York Stock Exchange, it's around 2%. What this means is that if you had invested in the stock market, your dividends that you'd be receiving versus the price you paid for that stock would average around a return of about 2%. Now, when bond yields go above that 2%, then investors start going to bonds as opposed to staying in stocks, because stocks are supposed to be a lot more dangerous, a lot more risky, and yet bonds are supposed to be the safe haven, and now they are yielding more than equities. So higher bond yields will then lead to a poorly performing stock market. That is another expectation we have for Q2. So we'll be short a lot of stocks, especially those, one, we feel are overvalued, and two, have poor dividend policies. All right, so that is it. Let's go into the questions now, Ella.
Great. Thank you so much, Nahashan, for that informative presentation. I think it has answered a lot of questions that were coming in. I know there was a question of what is this exactly? Someone is new here. And we can still keep shooting the questions as we go along. We have 3 people or further people that will be assisting Nahashan answer the questions. So yes, please keep asking the questions as we go along. Nahashan, let me start with a few that came in for you. When a client account performs below the fact sheet declared return, percentage return or profits for the period of time, does Mansa X always credit the client's account the percentage profit stated in the fact sheet? And tied to that question, there was another one. If the return is below the fact sheet, if the return on the statement is below the fact sheet, do you alert the client before? I don't know how it would be below, like whatever I have earned in my account is below what has been declared in the fact sheet. I don't know how that would occur.
Yeah, that can happen, Ella, especially depending on when you join the fund. You see, this is a market determined return. What we actually give in the fact sheet is an indicative of, you came in on day one of the fund and 1st of January to 31st of March, for example. Mm-hmm. Now, if there was a discrepancy in when you joined the fund, for example, say you joined on the 10th of January to 31st of March, for example, then your returns might be different from the fact sheet, because then you probably missed a few days that were profitable and came in on days that were not, because it's a market determined return. This is not a straight line interest fund. Is typically most fund managers will do what you call money market investments, where you put in money and then they say buy a bond, and so everything is really just based on the coupon that bond is paying, and it's amortized over the period of the investment. This is a bit different. So yes, Ella, that can happen depending on when you join the fund, but this is something you can go through with your relationship manager to understand, because it's the same reason why you'll find some clients have a higher return than the fact sheet. The reverse also happens. Of course, we rarely get them calling us to ask us about that, but that's because maybe they missed some bad trading days and came on the good trading days, and therefore they actually beat the return of the fund. So both ways that can happen. And for those investors who are uncertain about how their returns look and how that was calculated, you can always reach out to us and we can take you through. Another thing I noticed is some investors will do withdrawals and contributions during the period of their investment, and therefore when they calculate, some of them calculate the wrong way because they're forgetting to do what you call a weighted average return of what they've invested with us. But that's something, again, we can deal with if they give us a call, and we can calculate with them and show them how it works.
All right, perfect. I don't know. Jim Gitao asked, how are the gains from global markets delivered into our portfolio, and how do we hedge against forex?
How do we hedge
against the forex?
Sorry, I think I didn't understand that question very well.
Okay, Jim, I think you can elaborate, but how are the gains from the global markets delivered into our portfolio? I think that's through the diversification that you have talked about, and it shows us the asset classes.
Yes.
How do we hedge against the forex? I also think that is also with the diversification that we have for the fund.
Yes.
Yeah.
And even just to answer that question, because maybe her concern is, how do you protect yourself from all this currency volatility? Maybe that was our concern. Mm-hmm. So we use various, and that's why you'll notice one of our biggest asset classes are actually forex derivatives. So what forex derivatives do, they smoothen the return of the fund by protecting against volatility of various currencies that we are invested in. So that's one of the ways, again, we protect against that currency volatility.
Okay. And what is your view on the US tech stocks in the long term? Is there an opportunity to take a position at a lower entry price?
Of course, for US stocks, we look at them just like every other stock market. We feel that we look at valuations of companies, so we're very interested in that. We look at growth companies, but we're also very keen on properly yielding dividend stocks. We had mentioned this last year, and that continues to be our policy. So a lot of the stocks that we hold long positions in are the ones with a good dividend policy. Those are mostly utility stocks. We expect utility stocks to continue doing very well. We mentioned a few defense stocks earlier. We continue to hold positions with those. We still think that this will perform well. Do you think you can get better valuations and buy some of these stocks cheaper? Absolutely, especially with technology stocks. We feel that a lot of them were highly valued, and that overvaluation will come into question as the price of money goes up because of the inflationary pressures that are causing central banks around the world to increase their interest rates, especially the Federal Reserve. So yes, to answer your question, yes, we expect that for technology stocks, you can wait and you buy them much lower, or simply go short those stocks, which is what we've done at Mansa X.
Oh, great. I think you can combine that with oil. There is a question on oil. What is your outlook for the oil market? I think you had mentioned it, but maybe perhaps you can, just repeat it.
Yes, we are still bullish on oil. Bullish meaning that we expect prices will continue to soar. Geopolitical tensions are still there. that will continue pushing prices higher. We still have supply chain concerns. Like I mentioned earlier, just the ability to deliver a commodity on time is becoming more and more difficult. And this is creating, if you're an oil marketer or you're an oil supplier, to manage the costs of how long your tanks are delayed at various ports around the world, the obvious thing is to raise prices. So yes, we still expect that there'll be upward pressure on oil prices. In fact, we think oil prices will most likely head towards $120 a barrel, at least for the WTI.
Okay. Then shall we ever see the kind of returns we witnessed in the final quarter of 2020? Tied to that, there is a question that came in earlier on the decline of the return since 2019, 2020, yes, 2021. Of course, because also I would also maybe tie it to what has been happening in the world, but maybe you can just answer it for us, Mahashan. Yeah.
Well, we are hopeful that yes, we'll go back to those sort of returns. Volatility is your friend. We had a very flat January starting. Actually, January, a lot of our positions had to be rebalanced, mostly because we went into 2022 long a lot of stocks before some of the fundamentals shifted. So there was a lot of rebalancing of our portfolio in the first month of this year. And I'd say maybe that's why our return was slightly lower. I still think that our performance was pretty good compared to what other fund managers returned. But yes, we are hopeful that our returns will most likely go back to where they used to be. We had a good run in 2020 because of, we had this new market moves created by the COVID pandemic at the time, and we took advantage of that. Right now, because of what we are seeing around the world, it's our expectation again that we'll go back to those exciting markets where you can now squeeze in a higher return. So we think that moving into Q2, our returns will be better than even what we have delivered in the past. In fact, if you were to single out January from our returns this year, our return would most likely have been towards 17%. January dragged us down because of that rebalancing of the portfolio that had to happen. But again, we do that to protect our investors.
Okay. All right. I think you can take a sip of water.
Okay.
As we continue.
Okay.
Yes.
All right.
There is a question on ExxonMobil exiting Russia. How will the exit affect Mansa X investments? And then how are the recent charter? Has the recent charter on FX availability impacted your business? And how do you foresee as the short-term to medium-term impact on this? I think we can have you, or we can have Jesse help you answer those.
All right, Jesse, go for it.
Yes.
Yes. Can you hear me?
Yes, we can, Jesse.
Yes. So to answer on the ExxonMobil question, yes, in the short term, we do expect that they will be affected because they had significant investment in Russia, especially in the liquefied natural gas space. However, due to the operations everywhere else in the rest of the world and the rising prices of oil in comparison to where oil prices were last year, we do anticipate that their revenues will not take a significant hit. It's the same with natural gas prices, how they have performed during this period that Russia has invaded Ukraine. The prices have shot up. So as much as, yes, they have exited one market, they still have significant operations in the rest of the world, which if you combine with rising prices of the commodities that they do supply, then yes, we anticipate that their revenues will not take as big a hit.
Okay.
Yeah.
All right.
What was the second question?
The second question, let me look for it. But in the meantime, you can tell us, do you invest in cryptocurrency? And if not, why?
So At the moment, we do not invest in cryptocurrency because of two reasons. First is on a regulatory standpoint. Given that we're a regulated fund, we are not allowed to invest in asset classes that our regulators still consider to be, they're not friendly towards those asset classes. Let me put it that way. However, secondly, on our side as well, on the trading desk, you see, we try to, our first job we see ourselves as here is risk managers. So we try to manage our risk of our clients in a very, very calculated manner. And the wild swings that we see in cryptocurrency would really throw the fund off, and they would affect our clients' returns. They could affect them positively, but there's also a huge possibility that they could affect the returns negatively. And that's not something, even if we were allowed to do at the moment, it isn't something we would embrace just because of that. Yeah.
All right. I have found the other question. Has the recent chatter on Forex availability impacted your business? And what do you foresee as the short to medium term impact for this?
Maybe I can take that one.
Yes.
So one of the reasons why there is a bit of shortage of dollars in the market is because you had a situation where a lot of companies were paying dividends to their foreign shareholders. And don't forget that a lot of these companies had not paid dividends for about 2 years. And now when they did, their shock on the interbank system was quite significant. So we feel like it's a short-term problem. And we don't think, we believe that, the central bank is doing what it takes to fix that problem. We've seen the FX results actually increase the last few weeks due to collaborating with the World Bank and IMF. And we expect that this will remedy the situation very soon. How does it affect our business? We are very fortunate that we had always had a policy of holding some of our dollars because of the activities that we do and the investments that we make. But obviously, one of the ways it affects us is it actually sometimes helps our returns, because if the shilling then loses value and some of our investments are in dollars, then we then get a better return for our investors because we are Kenya shilling denominated fund. So that's how it affects our business as well. But we think that it's not going to be a long-term problem.
Okay. I also think it's a short term. And in light of that, what would be the equivalent return in terms of euro or dollar if someone was to invest in such a currency now in Mansa X, given that we have a base currency of KES, an annualized return at 15.4. So if I was to invest in dollar or euro, what would be the equivalent return?
Well, what we'd have to do for that investor would be to hedge out their, the currency volatility through maybe using Forex forwards or options. What that would have the impact of doing is shaving off about 8% from that return. So if we are returning about 15% in Kenya shilling terms, we might return about 7 to 8% in dollar terms. That would be the impact, but that is doable. All
right. I think you can take this one as well before you take the next sip of water. The rate of return appears to be inversely proportional to the size of the fund. As the fund size grows year on year, the percentage return seems to be going down. Please comment. And in light of that, there was someone else, let me tie it to another question. Someone had asked what is the capital of the investment. So I think they meant what is the fund size.
Okay, the fund size is 8 billion shillings. And no, the return of the fund is the return of the fund is not inversely proportional to the size of the fund. I just call it coincidence. In fact, sometimes when the fund is bigger, you're able to get into a lot more opportunities, which can actually increase your returns. It's just the way the markets have behaved that you might get the feeling of the impression that because the fund has grown bigger, then the return is lower. That's not the case at all.
Okay. Then what benchmark do we use to evaluate Mansa X against?
Oh, that's a good question. I guess the biggest challenge for us is we don't have a fund that invest in the kind of asset classes that we do locally. So it becomes very difficult to compare our returns with what other fund managers are doing, or to create a sort of benchmark that would make sense. Because if maybe the best thing would maybe to compare with what the risk-free interest rates for 1 year would be, because essentially, if you're investing in a fund like ours where you can access your funds at any one time, then you should compare us with the shortest risk-free money that you have out there, which would be at around 6 to 7% on a yearly basis. So now that may be the best way to compare our return. But globally, then you'd probably, you can compare us to other hedge funds around the world and how they have performed. You can go to something called the Barclay Hedge Fund Index, where if you look at how they are performing, then that is very closely related to how we should be performing, because we're in the same asset classes. That might be a more realistic comparison.
Oh, great. And I agree. There was a question on the trading strategy. So how do we make money from the shorting? So they said, maybe you explained it at the beginning, but they joined later. But you can explain now the investment strategy that we use. The short trades, yes, the combination.
All right, so our trading strategy first is diversification. So we'll invest in very many asset classes. And diversification in the real sense of the word, meaning that we don't get into asset classes that have direct correlations and then call that diversification, because it's not. So we will invest in various asset classes, from equities to metals to commodities to stock indices and so on, with a view to spreading out that return and making return, and also protecting the downside risk. Because our main job, as Jesse had said earlier, we consider ourselves risk managers, and we always believe, and I've said this many times, that our biggest philosophy is that if you protect the downside, then the upside takes care of itself. I see a lot of investors concerned about returns and wondering, the return was lower and so on. If you look at how markets traded that first quarter, most fund managers would have actually made a loss for you during that period. But we were able to make a return for you because we're always watching the downside. And one of the ways we do that is by rebalancing the portfolio to align with the current dynamics. And that's why I mentioned, for example, when we started the year, a lot of things changed from inflationary concerns to geopolitical tensions and outlook. And that meant that we had to flip our book for a lot of technology stocks, even the ones that we like. We had to flip that to short positions. So we actually make money when those stocks are losing value. And that's how we were able to make money from there. So our trading strategy is mostly just to align with fundamentals globally and to take advantage of this. The second strategy that we use is that we get into strategies that create a lot of capital efficiency for the fund. So a lot of our trading is done through derivative contracts, so that we can have as much cash available at any one time to also boost the amount of positions that we can take. And this, again, is also very unique to the fund.
Great. I don't know whether Victor Marangu is with us. He's the head of distribution at SIB, Standard Investment Bank. Victor, if you don't mind, as Nahashon is taking a sip of water, the next few questions are yours. Is there a way of knowing the interest earned per month? In terms of, yes, if I have invested, I know the statements are sent on a quarterly basis, but is there a way I can be able to calculate the return that I've earned on a monthly basis? And you can tie that to another question. Who are the trustees? Like, what is the structure of Mansa X in terms of legality? Or maybe Jesse can answer that.
Okay, maybe Ella, let me help with that one, yeah?
Okay.
In terms of the structure. So currently we are what is classified as a special fund by the CMA, but there are some regulations that, some draft regulations that came out last year from the CMA regarding what you call CISs, collective investment schemes. And one of the new categories that they created was something called a special CIS. So I'd say that we fall in that category of a special CIS. And now what changed is that before we never needed to have a trustee for the fund, but now this has changed. And we recently appointed Kingsland Court as our corporate trustees for the fund. So we actually have a trustee as well. And this is even before the regulations have come out. So we're in compliance even before the regulations have been published to the general public. So you have your our custodians are I&M Bank, then you have our trustees as Kingsland Court, and then the fund is overseen by the investment committee within Standard Investment Bank, which also reports to the board of Standard Investment Bank. So that's the structure of the fund.
Okay, great. I think you can tie it to another question. Does Mansa X publish its financials, and how are you performing in terms of your own revenue and profit growth?
Yes, so we will start publishing at the end of this, and we published for last year, actually. Yes, someone is reminding me that. Yes. So we actually publish, and for anyone who wants published accounts, we can always share with them on email. And how are we doing? We could do better if maybe we increase the number of clients that are investing in the fund as well.
Oh, wow. Okay. Okay. Let's see. There are people who have raised their hands up. Please kindly type in the questions so that we can, at least we are doing the best to read all the questions that are coming. But the question to Jesse still stands. Is there a way of knowing the interest earned per month? How do you calculate?
Hello? Yeah. So at the moment, hello? Can you hear me?
Yes, we can.
Yes. At the moment, we provide our statements on a quarterly basis. And that has been our policy, I believe, over the last 2 years. Yes. So we do not provide monthly return statements.
Okay. So once you do maybe quarterly, you can maybe perhaps divide by the number of months that you have been there and see how much return you have paid per month. Yes.
Yes, that can be a method a person takes.
Yeah. All right. Nahashon, this comes back to you. As you said, in January, the low returns were because of rebalancing. Did you mean that the low returns are due to the transactional costs caused by rebalancing, or what aspect of rebalancing leads to losing something, the low returns, basically?
Well, rebalancing creates something you call a lag. So between a period where you're selling certain stocks to buy other stocks or exiting certain asset classes to get into others, it means at that particular point in time, you don't actually have exposure to anything. So of course that means you're earning nothing. And that's how rebalancing affects your return. But again, if you do not do it, the long-term health of the fund is affected, because then the underperforming assets will eat into your return in the long term. So it's short-term pain for longer-term gain. But yes, that's how rebalancing affects. Not really because of transactional costs, which they're not very significant within the fund because we negotiated with our counterparties. It's really just the lag between getting into positions or exiting them.
Okay, perfect. I think the last time we actually talked about a product that's for a lower minimum initial amount, yeah?
Yes.
So, yes. What is the progress on that? What is the progress on the app?
Yes, we made significant progress. And I feel bad having to say this again, because I think the last two webinars or so I've said that this product is almost done. But yes,
we really put you on your toes for delivery for that.
I think so, yeah. This particular one, yeah, we are about to launch it. We believe by the end of Q2 we should be ready with it. We definitely need to drop the minimum investment amount for investors and potential investors.
Okay. All right. And then what happens when there is a negative return on portfolio, and how is the 5% deducted? Is it recovered from the principal investment?
I'd say if you had a negative return, and we're fortunate not to have had one, but if you had a negative return, because it's a market-determined fund, look at it from a perspective of it's a long-term investment, and we always tell our investors to look at it from the fact that what you pay as management fee is really just the work that goes into managing those funds. It's not like a profit share. It's not like, okay, you made something, so we took something from that. No, it's really just something we charge you because of the amount of effort it takes to run a fund like this. So in the case, for example, you got a negative return, it will be very difficult for us to say, okay, we're giving this money back to you because we still invested the same resources to make that return, positive or not.
All right. Great. Yeah, I think anybody who is asking about the online portal, Nahashon, I don't know what's your comment on that. Maybe a Q2. The
online portal?
Yes. How someone can be able to view their statement online, perhaps see their performances. Yes.
Okay. If we get enough demand for that, we can create it. But this is a market-determined fund, so your investment goes up and down on a daily basis. I'd be hard-pressed to find a lot of people who would be comfortable with that, with the emotional burden that comes with, because then you'd have to be seeing your portfolio change in value every day. And that's one of the reasons why we give quarterly returns, just to take the heavy burden of seeing that volatility in the size and then the performance of the fund, and then report after the quarter is done. But if we see that a lot of our investors are interested in viewing daily statements, then we can invest in something that allows you to do daily viewing.
All right.
We just need, we need economies of scale to justify it.
Okay. I think I would actually not be sleeping at night. I've tried Forex trading just recently.
A lot of investors will tell you they want to see their investment on a daily basis, but from experience, I can tell you that they would really struggle to it's not easy.
Okay. And do you invest in bonds? I think we had that diversification. I don't know whether you can just go back to it.
Yes, absolutely. We do. We invest in bonds. In fact, that's one of our biggest holdings, treasury bonds, both locally and globally. In two very different ways of approaching those two. Locally, we have bought some bonds. Globally, we are actually short some bonds, because you can also go short bonds. We actually short the US 10-year, and we also short the German 10-year bond.
I think let me Marangu is back with us. Let me shoot this question to him. In short, if you can just, Victor, if you can just explain to us what, I know Nahashon had explained what Mansa X is in very few words. And also, as you do that, you can explain on the kind of clientele that you're looking at. What is your target client? So in that case, would you take a pension fund to invest in the Mansa X fund?
Thank you, Rosella. I hope I heard you. Somebody asked what Mansa X is?
Yes.
Yeah, Mansa X is, in brief, it's an investment solution brought in the market by Standard Investment Bank to enable the Kenyan investor diversify their portfolio into global markets and enjoy better return on investment, as opposed to the various asset investment solutions we have locally that deliver average returns of maybe 8 to 9% when you look at the entire portfolio performance. But when you look at a fund like Mansa X, gives that investor an opportunity to diversify part of their portfolio, let's say maybe 20 to 30% of that portfolio, given a global markets exposure, and then enjoy better return on investment. So it is essentially a product to enable a Kenyan investor enhance performance of the entire portfolio holding. So what we don't approach you and tell you to invest your entire holding with Mansa X. We're looking at allocating a certain portion, and then you see how this portion is acting or behaving or performing against your other asset you've invested. For example, if you look at a fixed deposit in a commercial bank, money market fund, government bond, or shares. For example, we've seen, like Nahashon said, if you look at the Kenyan market, the total domestic market capitalization about 2.4, 2.5 trillion Kenya shillings, and whereas we have the global market capitalization of about 119, 120 trillion USD. So if you look at that disparity, if you're just investing in the Kenyan stocks alone, you're so much exposed. If anything happens within this geographical location, then there's that geographical correlation. And also, you're left with the very few companies. If you look at honestly the NSE, there are very few companies that actually active and actually delivering real value to the client. NSE is dominated by one particular company with over 62% market cap, controlled by Safaricom only. So that is the kind of correlation and concentration risk we're talking about when we need now to diversify your portfolios away from the Kenyan markets and look at more developed markets. The other question was what, Rosella? Rosella, are you there?
Yes, I am. Sorry about that.
Yeah. So in short, if you are an investor and you probably put money in a money market fund or fixed deposit, you put some money in a fixed deposit of some form of real estate, what you are saying is that allocate a portion of your entire portfolio into global markets, give it a global markets diversification. That is what Mansa X, that is what Mansa X is all about, to defatigue the Kenyan investor of raw and unpredictable and unreliable return on investment. Because honestly, if you're giving me a return of 9% in the Kenyan context right now, in as much as we are told inflation is 5.8%, but if you look at sector by sector inflation, it is way higher than that. Therefore, if you give me 9%, and let's say inflation is at 6%, my portfolio has lost a value of 6%, and I'm left with a net of like 3%. And if you adjust for charges and taxation and everything, you are literally like the same way you were 12 months ago, 1 year ago, and things like that. And things could go wrong if now whatever you've invested in takes a hit, and then you now start worrying about even capital preservation, leave alone growth. So Mansa X comes as the ray of hope for the Kenyan investor, if I may say so. And I'm sure our investors are happy with what they're able to see in their statements every other time. And I hope this one will solve one of the questions I had earlier. When you're looking at your statement, you need to do not look at just one quarter. Always look at a 4 quarters average, like 1 year average. Those are 4 quarters. That is when you can actually benchmark. You cannot look at the return on investment for Mansa X by looking at 1 quarter. Maybe you've been in 1 quarter or 2 quarters, and then you start comparing and think that maybe treasury bills or treasury bonds will give you a better return. But if you look at a 1 year average, like those are 4 quarters at a return of about 4.39 average, it's way slightly above 17%, like Nashon said earlier. So it still makes sense to our investors.
I don't know whether Bakita, you have been answered with what Marango has said. The minimum amount one needs to invest in Mansa X as per now before they get the other product is a minimum. The initial amount is 250,000 shillings and a top up of 100,000 shillings.
Rosella?
Yes.
I've remembered someone asked what kind of clientele do you have in the fund? Mansa X allows both individual and institutional investors to come into the fund, because any investor, be it individual or corporate or institutional investor, is looking for like the 3 main objectives of our fund. We are looking at access to liquidity, capital growth, and of course, you don't anticipate to lose your capital. Okay, so capital preservation, access to liquidity, and capital growth. Capital growth can only be achieved through a well-diversified portfolio that generates inflation-beating returns that are way above the local market average. Thank you.
All right, thank you so much, Victor. There's a question that came in, and I think I shoot it to Nahashon. What is the percentage of portfolio have you invested in gold that is under Mansa X? B of that is there a platform in Kenya for trading gold ETFs? If so, what are the procedures, requirements for opening an account, if you may know? And then 3, have read reports which mention that gold could touch up to USD 2,600 per ounce by the end of this year. What is SIB's view on this?
Well, absolutely. We like gold as an asset class. It's actually one of the asset classes we have held for the duration of the fund. I'm not very certain I want to give the percentage holding of that unless I engage you separately. But yes, you can trade the gold ETF in Kenya. In fact, Mansa was the first fund manager in Kenya to trade the gold ETF. The procedure is quite simple. You can just buy it off the NSC because it's actually listed on the NSC. And the sponsors behind it is ABSA. So typically when you get into the trade, they'll give you pricing and then you get exposure to gold. To answer your question around the pricing, do we think, yes, prices can reach 2,600? Yes. We believe that gold prices will continue to rise. We saw a bit of a drop in gold prices, but this was not because of the underlying asset itself, rather a reflection of lower liquidity in markets, especially last year. But last year gave investors such as ourselves an opportunity to further increase our gold holdings at lower prices.
Great. I think that has also been answered to you, Ronald. Wani, yes. I think we need to wrap it up now. It has been a great session. And on top of that, we have very good remarks from investors, or maybe, yes, want to be investors. Congratulations to the Mansa X team. You're doing an excellent job. Keep it up. Nahashon, good job.
Thank you.
Good job with the
Thank
team.
you.
Yes. I don't think there are any more questions, but in case there are any questions that are coming in, kindly make sure that you can you email them to SIB. You can, and then they will be able to answer. Yes. Asanteni sana for the patience of 1 hour plus. It has been a good session. And I think we have actually covered all the questions, unlike the other time, yeah? We have covered all the questions that we had. And in case you missed pre-recorded part, there was a pre-recording from Nahashon on the Q1 performance.
Yes.
The link is there on the chat box. It can be sent to you on email as well. Please make sure that you have a diversified portfolio in the coming year. Asante.
Yes, and just to support Ella on that, please watch that video because it helps to answer even a lot of the questions that came up today, especially around our trading strategy. And we'll keep releasing as many videos as possible to enlighten our investors and potential investors about how we run this fund. Thank you. All right.
So we have 2 things, Nahashon, take home. One, I will be following you up on the products, on the lower initial minimum products.
Okay.
Yeah, that one, it has to be done by Q2.
Let's do it.
Let's do it. Yes.
Fair enough.
And then I think we need to be doing this as often as possible so that people can understand what the product is. Yes.
Agreed.
All right. Okay.
Thank you.
Thank you so much, SIB, for agreeing to do this. Everybody who joined in. As I said, the recording is on YouTube. So if you want to rewatch it, you can go to the SIB's, that is Standard Investment Bank YouTube channel. We shall also try and have it on our Vasili channel. So yes, you can, keep engaging us as we make financial literacy not a dream but a reality for everybody. Thank you so much.
Thank you.
Thank you, Rosetta.